Okay, so a very good evening to everyone. So we'll just begin the session, the live discussion at 7:05. Till then, kindly share all of you, the students who have joined the live session. Kindly share the session so that more students can get involved in this. It will be an interesting one. So I want all of you to share it as much as possible and make it more interactive. Like, I'll be asking some questions as well, so kindly respond those to those questions and you'll enjoy it. It should be a two-way process, not a single one like only I am speaking. So it should not be that way. It should be informative and interactive as well. All right, so we'll begin with it. I'll just share my screen. Just give me a second. All right, so I hope my screen is visible to you guys. Now we'll just begin with it. Okay, great. So so now we'll begin with the previous year question paper analysis, which is of prelims 2022, and we'll be talking about economics as of now, and we'll be bringing to you some other live discussions as well, so stay tuned for others also. And I want maximum participation as well. And I want the session to be interactive. So if you guys have any questions, you can just pose those questions, and I'll be happy solving those questions in the end of my discussion. So let's come to the first question, that is rapid financing instrument and rapid credit facility are related to the provisions of lending by which one of the following? So the options that were there were ancient Asian Development Bank, International Monetary Fund, United Nations Environment Program Finance Initiative, and the World Bank. So the answer to this particular question was International Monetary Fund. Let's just go into the in-depths of it. So, firstly, talking about the two main concepts that were there in the question itself. So, firstly, we have rapid financing instrument and rapid credit facility. So, rapid financing instrument is basically a lending facility that is provided by this particular financial organization, that is International Monetary Fund, that provides quick financial assistance to all the member countries which have a deficit in the balance of payment, in order to check into any deficiencies that are there in the balance of payments of those particular member countries of IMF. This particular instrument is there to finance those countries. And also, along with that, it has something called the IMF's General Resource Account, which is created by the organization to make this financial support more flexible for the countries and more easier for the countries. Then next, we have a rapid credit facility. So this particular facility is basically for those countries, for those member countries of IMF, which are low income countries, which are poverty ridden countries, or you can say developing countries. So whichever member country, whichever low income country needs any financial support in case of its deficit BOP, so that gets checked by the organization itself using this particular facility, that is the rapid credit facility. So this is a part of the IMF's Poverty Reduction and Growth Trust, and it offers a flexible financial support for those countries during the time of crisis. So basically, you can just remember this by rapid financing instrument is for all the member countries, to provide a more flexible financial support for the member countries of the organization, whereas rapid credit facility is another lending facility provided by the organization, but that is limited to the low income countries in case there is any um, deficit in the BOP. So moving ahead, the question talked about various organizations. So since financial institutions and financial organizations, they play a very vital role in the development and the growth of any country, and it forms um, a vital part in the you in the competitive exams as well. So we'll talk about the others also. Like first option was related to the Ancient Development Bank. So basically, this is a development bank that was established in 1966 with its headquarters in Manila, and it's basically to promote the economic and the social progress in the ancient and the Pacific region of the world. And also, no, it also provides financial assistance, technical expertise, and policy advices to its member countries. And India has been a founding member of this particular organization and has gained a lot of support in the fields of infrastructure, energy, education, and skill development projects. Then we talked about the IMF. So, a more in depth detail of it. So, it's basically an organization of 189 countries, which was established in the year 1945 in order to promote financial assistance, financial stability, in order to foster global monetary cooperation, and facilitate smooth international trade and support sustainable economic growth in the countries. And also it has been one of the institutions of the Bretton Woods, like the World Bank as well. And it aims to reduce the poverty in worldwide. So because of that reason, as we talked about it, it provides this lending facilities to the low income countries, which are poverty ridden countries. So also in 1969, this particular thing is really important, as it was created by the International Monetary Fund, and it can also it can be asked separately in a question also. So there's something called special drawing rights SDR, which was created by the International Monetary Fund in the year 1969. So that's a kind of reserve asset that is created by this particular organization, in which the reserves of the various member countries are stored. And by this, what happens, the currencies of various countries can be exchanged and used freely and quickly in a smooth manner. So not to forget India, it is also a member of IMF, like it's a member of ADB as well. So it's a member of IMF also, and holds about 2.75% of this particular special drawing right quota, and 2.63% of the voting rights, sharing its constituency with three countries, that is Bhutan, Bangladesh, and Sri Lanka. So coming to the next option that we had, UNEPFI, that is the United Nations Environment Program Finance Institution, which was established in the year 1992. And what happens over here, it is there to promote sustainable finance by integrating environmental, social, and governance factor into decision making. So in India also, India has been a member of this particular organization, and it collaborates with the banks, insurers, and the investors to support the sustainable development goals, climate action, and green finance initiatives. And also India has been contributing a lot to the environmental protection and enhancing the climate resilience efforts by way of this organization, with the help of this organization. Then next up we have the World Bank. So World Bank was basically established in 1944 at the Bretton Woods Conference to foster international economic cooperation after the World War II. So initially, it was not World Bank, but it was named as International Bank for Reconstruction and Development, because it was for those countries which have been, shattered by the World War II, by World War II. So it was to support the post-war reconstruction. It was basically created for that purpose. So it was named in that way. But after that, it was renamed as World Bank, comprising of many sub-organizations as well. So India has from the start been a founding member of this particular organization, that is World Bank, uh, and have also actively participated in its governance and decision making processes, and has also benefited both as a borrower and as a recipient of technical assistance from the various World Bank Group institutions over the years. So here we mainly talked about four organizations, that is Asian Development Bank, for which India was a member of it. And we also talked about the International Monetary Fund, which basically provides with the two lending processes. And India has been a member of this particular organization as well. Then we also talked about UNEPFI and the World Bank. So all these were in the question, in the options of the questions. The correct answer being the International Monetary Fund for that particular lending process. All right, and India has been a member of all the four organizations. Now we have also included some expected questions for you all in order to enhance and broaden your perspective of this particular question. So you can just check out the answers to these particular questions, that is the expected questions, which I'll be talking about after each question. So these are basically uploaded on our YouTube channel as well as on our Arthran page, Arthran Instagram page, We Educate. So you can just check out those reels as well for more information. And also, you guys can make notes out of those. It's a very good reels are there. So they are very informative. So you can put down notes for yourself. So the first expected question from this particular question can be any other lending facility by the financial institutions. So firstly, we have the effective exchange rates, which are so first we have the effective exchange rates. So the effective exchange rates are of two types, which are near, that is NEER, nominal effective exchange rate, and real, that is real effective exchange rate. So all these I'll be taking it up in the next question, since it's on the that question is on the basis of that. All right, so the second can be, yeah, so second can be the credit control measures adopted by the RBI. So under this, the RBI, that is the Reserve Bank of India, which is the apex institution, as you all know. It is the central bank of a country. So it has two credit control measures, that is the quantitative and the qualitative measures of RBI. So the quantitative measures is basically to check to the supply of the money and quantity of money that is created, and the qualitative measures are there. So under quantitative measures, we have various other measures, like we have CRR, we have SLR, we have open market operations, we have bank rate policy. And under qualitative measures, we have we have markets, we have margin rates, then we have moral suasion. So all these come under the qualitative measures. So you can check out these two qualitative and quantitative measures of credit control adopted by RBI as well. The reels are there on our Instagram page, and also for more explanation you can always check out our YouTube channel of We Educate. So this is these are the expected questions from this particular question. So, moving ahead to the second question, we have, with reference to the Indian economy, consider the following statements. The first statement is, an increase in the nominal effective exchange rate indicates the appreciation of rupee. Second statement is, an increase in the real effective exchange rate indicates an improvement in the trade competitiveness. The third is, an increasing trend in the domestic inflation relative to the inflation in the other countries is likely to cause an increasing divergence between the two exchange rates, that is near and rear. So the correct answer to this particular question is option C, that is 1 and 3 only. So let's just talk about its explanation. Yes. So the nominal effective exchange rate is a measure of the country's currency value against the weighted average of the other foreign currencies. It is a broad value which is typically represented as an index that is used to access the strength and the international competitiveness of a country's currency. An increase in this particular exchange rate indicates an appreciation of the local currency with respect to the other currencies of the world. So moving ahead to the real exchange rate, real effective exchange rate, it is the weighted average of a country's currency in relation to an index or the basket of other major currencies of the world. It compares a nation's currency value to the weighted average of its primary trading partner's currency. An increase in this particular exchange rate indicates that exports are becoming more expensive while the imports are becoming more affordable. Okay, so I'll just give you a hint in this. So whenever you see the word real in front of any concept, be it be it nominal income or real income or any other concept, wherever real is used, it is with respect to an increase or a decrease in the price level of a country. That is, it includes the price level of that particular country. Whereas nominal, if more nominal, wherever nominal is used, that does not tell us about the changes in the price level. The real tells us about the changes in the price levels. So if India experiences a higher inflation than its trading partners, the near may not change much, but the rear will increase because the country's domestic countries real value is eroding due to higher prices. The divergence occurs because the rear is adjusted for inflation while the near is not. So as I mentioned of that, over here it's mentioned rear is adjusted for inflation. So what is inflation? Inflation is a persistent rise in the general price level in the country. All right. So means when इन सिंपल वर्ड्स आई बी टॉकिंग अबाउट, जब हमारा जो प्राइस होता है वो इंक्रीज होता है, तो ऑब्वियसली हमारे जो गुड्स होते हैं, वट एवर वील बाय, those will be more expensive for us because of the increasing prices of those countries, of the currency. So what happens when there is inflation or when there is an increase in the price level? Obviously the exports would become more expensive, and the imports would become more affordable. Why? Because imports are the goods that are coming to the country, whereas exports are the goods that are leaving our country, that is going to another country. So basically what happens, the price of the commodities are really high of the domestic goods, and when we are exporting those goods, obviously those will be available at a more higher rate, at an expensive price, whereas whatever we'll be importing, those goods would be comparatively cheaper for us. So obviously the imports would be higher than the exports. So that is why over here what happens in case of inflation, the rear may not change, but the near may not change, but the rear would increase. As I gave you the hint, real always talks about the increase or the decrease in the price level of a country. All right, so I hope you have understood this particular question. So let's move on to the next part, which is with reference to the Indian economy, consider the following statements. First statement is, if the inflation is too high, Reserve Bank of India is likely to buy the government securities. Second is, if the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Third is, if the interest rates in the USA or the European Union were to fall, it is likely to induce RBI to buy dollars. So, which of the statements given above are correct? So, the particular answer to this question is answer B, that is options 2 and 3 only. Let's just check out why this happens. So firstly, how does an open market operations work? So this particular question, it talked about the buying of government securities. So let's just go into the in depth of it. Why and how does the buying and the selling of government securities happen? So firstly, what do you mean by open market operations? So open market operations is basically a credit control measure that has been adopted by the Reserve Bank of India, that is the RBI, that is the central bank of a country. So that's a quantitative measure that has been adopted by the Reserve Bank, called the open market operation. So here what happens, the government, they buy and sell the government securities in the open market. So what happens, as you can see in this particular picture, you can see the central bank, it buys government securities. So when it buys government securities, obviously it is done to add money to the banking system. That is, it buys government securities which adds money to the banking system of a country. And why this happens, when the government securities are bought by the Reserve Bank, obviously there will be more money would be provided to the commercial banks and to the citizens of the country. And these particular uh, thing is done in order to bring about economic growth and prosperity in the country. So, for example, a country is experiencing deflation. So, what would happen? Obviously, the people of the country, they have less money in hand. So, the government, it would buy the government securities by way of open market operations. And what would happen? This is done in order to um, give money to the or to add money in the banking system, which indirectly results in providing cheaper loans to the people, and so will bring about economic growth in the country, right? So on the other hand, what happens, if a country is experiencing inflation, that is when people, they already have when the price levels are tremendous in the country. So what would happen? The central bank, it would sell the government securities in order to remove the money from the banking system. And what would happen? This would result in expensive loans and would control the inflation. All right. So, in case of depression or in case of deflation, in order to add money to the economy, the government, the central bank, it buys government securities to bring about economic growth, to bring about to provide cheaper loans to the country, thereby checking deflation in the country. But in case of inflation, what happens? In order to control inflation, the central bank, it sells government securities to remove the excess money from the economy, to stabilize the economy from inflation, and and what would happen? The loans would be really expensive for the people, thereby checking the inflation in the country. So this is how open market operations work. Now let's talk about what happens when the prices of the bonds, they rise or they fall. What happens to the demand and the supply of bonds? So what happens when the price is OP, that is when the price is equal to 850, the quantity of bonds, it would be equal to 300. And so the demand and the supply of bonds, so the demand curve, as you all know, the demand curve is upward, the demand curve is downward sloping, whereas the supply curve is upward sloping. All right. So what would happen when the price is OP, that is 850, the quantity of the bonds would be equal to 300. So the demand and the supply would be at equilibrium, that is at point C, you can which you can see in the diagram, in the graph that is given. So what happens when the price rises from OP to that is from 850 to 950? What would happen? The supply would increase to I, whereas the demand would be at point A on the graph. On the demand line, you can see that point A is there. So the supply would be more than the demand because of the increase in the price. So with this excess supply, what would happen? The bond prices would again fall back to OP, that is from 950 to 850, in order to stabilize the economy and bring the economy back to the equilibrium level, that is at point C. Similarly, what would happen when the price would fall from 850 to 750? The demand would be more than the supply, that is the demand would be at point E, that is at the 750 line, that is at the at BD, that is the demand for bonds. So the point E, you can see over there. So the demand would be point E, whereas the supply would be at point F. So the demand would be more than the supply, and in order to check this excess demand, the price of the bond would again increase, breaking the price back to the equilibrium point, that is at point C. All right. So what happens? In a gist, I'll tell you once again. So when price rises, the supply would be more than the demand. With the excess supply, the bond prices would fall back to the equilibrium at point C, that is at OP price, where price will be equal to 850. For example, the price falls from 850 to 750. With the fall in price, the demand would be more than the supply. So what would happen? With the excess demand, the bond prices would again rise back to the equilibrium point, that is OP, which is equal to 850 at point C. All right. So, coming back to the main part of this question, so the first statement was related to when inflation is too high, the RBI tends to decrease the money supply in the economy. Hence, the RBI will sell the government securities to reduce inflation. Therefore, statement one is incorrect. All right. So, as I already told you, when there will be inflation in the country. The RBI, in order to decrease the money supply in the economy, it would sell the government securities to remove the money from the banking system. And so it would provide more expensive loans to the people, thereby checking the inflation. All right. So statement 1 is incorrect. Statement 2, depreciation of rupee takes place when the demand for dollar is more than the supply. It refers to the fall in the value of the domestic currency. The RBI, they can sell the dollars in the economy to increase its supply. Therefore, statement 2 is correct. So obviously, depreciation of rupee, when would this happen? When people are demanding more of the other currencies but less of the domestic currency. So obviously, the value of the domestic currency would decrease, and the demand for the other currencies and the supply would be and its supply would be more. All right. So, statement 3 says, if the interest rate in the US and the European Union fall, there will be an increase in the inflow of US dollars in the economy. To reduce the supply of dollars, the RBI will buy dollars. Therefore, statement 3 is also correct. So, statement 2 and 3 are correct, whereas statement 1 is incorrect. So, coming to the fourth question, with reference to G20 common framework, consider the following statements. The first is, it is an initiative endorsed by the G20 together with the Paris Club. Second is, it is an initiative to support low income countries with unsustainable debt. Which of the statements given above is or are correct? So we have option C as correct, that is both 1 and 2 options are correct. Let's just see to its explanation. So G20, or the group of 20, is another organization that was founded in the year 1999, and it's an intergovernmental forum comprising of 19 sovereign countries of the world, the European Union and the African Union. So it comprises of 19 countries consisting of Argentina, Australia, Brazil, Canada, China, France, Germany, India, Indonesia, Italy, Japan, Republic of Korea, Mexico, Russia, Saudi Arabia, South Africa, Turkey, United Kingdom, and the United States, along with European Union. So the question also talked about the Paris Club, that it is an initiative by G20 along with the Paris Club. So what basically the Paris Club is? It's a group of major creditor countries aiming to provide sustainable way to tackle the debt problems in debtor countries. Coming to the G20 common framework, so it's a mechanism to help the countries restructure the debt owed to multiple lenders. It was created by the G20 nations along with the Paris Club, a group of creditors from developed nations. The framework aims to help the countries with financial difficulties get back on track. So yeah, we talked about that. This particular framework is a collaboration of G20 and the Paris Club. The first statement becomes correct. The second was, it is to support the low income countries with unsustainable debt. So yes, that particular statement is also correct, because it is basically to check the countries with financial difficulties. All right. So again, the Paris Club, it's an informal group of financial creditors which was established in 1956, which consists mostly of the Western nations. It originated from a meeting where Argentina agreed to negotiate with its public creditors in Paris. And currently, there are 22 permanent members, including USA, UK, France, and Japan, and all the members are part of the Organization for Economic Cooperation and Development. And notably, India and China are not the members of the Paris Club, which primarily focuses on debt negotiation. So you can just highlight and keep this point in mind, that India and China are not the members, on are not part of the Paris Club. So this particular question can also be a part of your question in the next upcoming exam. So just keep this point in mind. Now, the expected question from this particular question can be G20, about G20 summits. So, firstly, it was established in 1999 following the ancient financial crisis that were held 1997-98. So it basically was created to address or to seek to the financial instability that these countries, the east and the southeast Asian countries, were facing, the financial crisis that they were facing. And also after 2008 global financial crisis, this particular thing got elevated to the level of heads of the state or the government for effective crisis coordination. And in 2009, it was declared as the premier forum for international economic cooperation. Its members account approximately 85% of the global GDP, 75% of the international trade, and two-thirds of the world population, emphasizing its global economic significance. So again, the G20 summit, let's talk about the latest ones only. So the 18th G20 summit, it was held in 2023, where India was the host, and this particular conference was held in New Delhi, and the host leader was our Prime Minister, Mr. Narendra Modi. Then next up, we have the 19th G20 summit, which would be held in 2024, that is from November 18 to 19, and the host country is Brazil, and the host city would be Rio de Janeiro, and the host leader, of course, would be the president of Brazil, Luis Inácio Lula da Silva. And the 20th G20 summit would be held in 2025. The host country would be South Africa. The host city is yet to be declared, and the host leader would be the president of South Africa, uh, Cyril Ramaphosa. Also, the expected question from this particular question can be the other organizations, like we have G20. So we have other organizations like group of seven. We also have group of eight. Then we have the BRICS, which comprise of Brazil, Russia, India, China, and South Africa. So that's basically named according to the initials of the various countries, the five developing countries. Then we have the World Trade Organization, which came after the GATT. Then we have the Organization for Economic Cooperation and Development. Then we have the North Atlantic Treaty Organization, that is NATO. Then we have the Asian Pacific Economic Cooperation, that is APEC. So these institutions are really important for you all. Kindly check them out, and yeah, make notes of these organizations, as they can be can uh, are in the expected questions. Yes. So the last question for today is, with reference to the Indian economy, what are the advantages of inflation indexed bonds, that is IIBs? So yes. So the first statement is, government can reduce the coupon rates on its borrowing by way of inflation indexed bonds. The second is, IIBs provide protection to the investors from uncertainty regarding inflation. The third is, the interest received as well as the capital gains on IIBs are not taxable. So, which of the statements are correct? So, answer A, option A, that is 1 and 2 options are correct. Let's just go into the in depth of it and understand why. So basically, inflation index bonds is a special type of bond that ensures the investors receive a consistent return regardless of the changes in the inflation. Interest payments on the IIBs are taxable in the year they are earned based on the investor's tax bracket. The principal amount is adjusted regularly based on the changes in the income. inflation, sorry, interest payments are calculated using this adjusted principle. When the bond matures, you get back the adjusted principal or the original amount, whichever is higher. If the market overestimates future inflation, the government will reduce borrowing costs by issuing indexed bonds rather than the nominal bonds. So, what does this particular explanation talk about? So, inflation linked bonds or inflation indexed bonds, these are related to these government bonds are related to inflation, and the interest rate of inflation linked bonds is generally lower than the fixed rate bonds. All right, and also the interest payments are on this particular bond are taxable in the year in which they are earned, based on whatever tax bracket the investor is in. Also, when the bond matures, you get back the adjusted principal to that particular amount or the original amount, whichever is higher. And also, if the future inflation is overestimated, so what would happen? The government would initially reduce their borrowing costs by issuing these particular bonds rather than the nominal bonds. All right, so there are certain features of this particular bond. Firstly, the coupon payments. So the investors, they receive a fixed interest payments biannually based on the adjusted principal amount, safeguarding the returns against the inflation. Uh, so that there is no loss basically to the investors. Then the investment term, so that's basically it has a maturity period of 10 years, offering long term investment stability. And as the government securities, these qualify for statutory liquidity ratio status, which requires that the banks and the financial institutions hold a certain percentage of their assets in the form of government securities in order to enhance the liquidity and security. So, as I talked about before in the first question, we have the quantitative measures of RBI, that is, we have the cash reserve ratio, we have statutory reserve ratio, or you can say the statutory liquidity ratio. That's basically to check the liquidity and provide security to the commercial banks. They need to hold a certain percentage of their assets in the form of these securities. All right. Uh, so that they can be converted very easily and quickly. Then the objective of this is to protect the savings of the middle class and economically weaker sections from inflation, from the effects of inflation. And the investment limits can be rupees 1 lakh annually, while institutional investments can invest up to 25 lakh per year, minimum investment being of the amount of rupees 5,000. Then the allocation, now as announced in 2023 budget, the distribution of this particular bond allocates 80% to the institutional investors, including the life insurance companies, the mutual funds, while retail investors, they receive only 20%. Then we have the auction process, that these particular bonds are basically directly auctioned by the Reserve Bank of the country in order to check the transparency and the accessibility for the investors. Then there are also certain advantages and disadvantages, that is, advantages being no inflation risk, whatever the inflation rate would be there. Obviously you will be there would be no loss for the investors. Then fixed returns are there, good long term investment would be there. Then the disadvantages are that lower potential than the investments, not a perfect measure of inflation, and tax on phantom income. Now, the expected question from this particular question can be the different types of bonds. You define the different types of bonds. So, there are various types of government bonds that are issued by the government. Firstly, there are traditional bonds. So, traditional bonds is basically a bond in which the entire principal can be withdrawn at a single time after the bond's maturity date is over. So the whole principal amount is given after the maturity. Then we have the uh, callable bonds. So these are when the issuer of the bond calls out his right to redeem the bond even before its maturity is reached. So even before the maturity, these particular bonds can be redeemed. All right. And also using this particular bond, that is the callable bond, a person, or you can say an issuer, they can convert their high debt bond to a low debt bond. Then we have the fixed rate bond. So, as the name suggests, when the coupon rate remains the same through the course of investment, it is called fixed rate. That is when the rate is fixed um, throughout the issuance of the bond to the maturity of the bond. So, the whole period, the rate has been fixed or locked. Then we have the floating rate bond. Again, as the name suggests, when the rate keeps on fluctuating during the course of the investment or the bond, the entire duration, the rates keep on floating or fluctuating. Then we have the mortgage bond. These are the bonds which are backed by the real estate companies and equipments. Then we have the putable bonds. So putable bonds are the bonds when the investor, they decide to sell their bond and get their money back before the maturity of the particular bond. So before, even before the maturity date, when the investor decides to sell the bond and get the money back. Then we have the so it is so this particular is quite relatable to callable bond. Next up, we have zero coupon bonds. So, zero coupon bonds are when the coupon rate is zero and the issuer is not applicable to repay any principal amount to the investor. So, they are called as zero coupon bond, as the name suggests again. Then we have the extendable bond. So, extendable bonds are when the investor can extend the maturity period of the bond. Then we have the war bond, which are issued by the government during crisis or during wars or any other financial crisis in order to raise funds for the country. Then we have the climate bonds. So these are also issued by the government to raise funds when the country is facing any kind of adverse changes in the climatic conditions. Then we have serial bond. So, serial bond is when the issuer continues to pay back the loan amount to the investor every year in small installments to reduce the final debt. So, in order to reduce the in order to reduce full amount in the end, and keeping a you can say keeping yourself involved in that along getting burdened with that particular debt, the government, the issuer, what does he do? He pays the amount in small installments so that there's no burden. Just say for example, we give emis, we take goods, we buy goods on emis. So basically what happens in emi, we pay small installments until the final thing is done, before which we get the good and we use that good. So you can just relate this particular bond to emi. All right, so yeah, that's it. So these were the different types of bonds that are there, and of course we have the inflation index bond, which is related to the inflation. All right. So from this particular question, we have this expected question. So that's it from my side. Stay tuned for the next part. I hope you enjoyed a lot. We'll be covering another set of questions in the part two. So whenever it is scheduled, do stay tuned for that. And also till then, just subscribe our YouTube channel, and stay connected with us through our Instagram page as well. And if you have any questions, you can And if you have any questions, you can just drop in your questions. So yes, an important point here is this, that we have changed we have changed from Arthran to We Educate. So we have our Instagram page as We Educate AR only, and our YouTube channel has also been titled We Educate AR. So stay tuned for another session. Thank you so much. I guess if you have any questions, you can just drop it. Else we can just close the live session for today and just wait for the next part. We'll have it shortly. Also, if you have any suggestions from your side, you can just drop in the suggestions also. Thank you so much. I hope you have found it informative. All right. So, since there are no questions, thank you so much, everyone, for joining today's session. We'll just close the session and do stay connected for the next part. Thank you so much.